It is safe to say that your credit score is a significant factor when you think of buying a house. Banks and mortgage lenders take your credit into consideration for what kind of loan you really may qualify for, or in some cases, whether you qualify at all. So what is considered a reasonable credit score to buy a house? And is it even possible to buy a house without a credit card? Well, keep on watching because in this video, I'll explain how to buy a house using your credit score. But if you're new to the channel, make sure to subscribe because we post videos every week for investors looking to dominate the real estate industry. So definitely keep watching. Every day, countless mortgage lenders around the country approve applications for first-time buyers with low credit scores. Mortgage lenders actually care less about bad credit than most people think. Mortgage lenders typically use a different credit scoring system from auto lenders and credit card companies. Mortgage credit scores range from 300 to 850 and utilize algorithms specific to the mortgage industry. But how do you know if you have bad credit? Experts say that bad credit is when your credit score or payment history falls short of your lender's minimum standards. A few mortgage lenders enforce a minimum credit score of 500 on a scale of around 300 to 850. Others set their floor at almost 580 to 620 or higher. Your credit scores are one of many predictors to a mortgage lender, and your minimum credit scores vary among lenders. Because lenders don't necessarily care about your credit score, they really care about whether you will pay them back each month. Lenders also care about your employment stability, annual income, home buying, and so much more. In other words, to a mortgage lender, there is no such thing as bad credit. You need to understand that there is only qualifying credit, which is the minimum score required to approve a mortgage application. So what are the factors that go into a credit score? Your credit score is basically influenced by multiple factors, from how frequently you pay your bills to how long you have owned a credit card. The 5 main factors that go into evaluating your credit score are as follows. Payment history. Mortgage lenders really want to see that you have a history of making consistent and on-time payments. You need to always make sure to always pay your bills on time and in full if you're able. Any missed, late, or insufficient payments will appear as a negative mark on your credit report. This factor significantly impacts your credit score, accounting for 35% of the calculation. Balances owed, also called your credit utilization ratio. This is calculated by dividing all your debts by the amount of credit available to you. You should try to keep it under 30% to have the best credit score. This is the second most vital factor in determining your credit score. Have a diverse credit mix. This is usually how many types of credit you have. Lenders generally want to see how diverse the mix of your installments, revolving, and open credit is to show whether or not you can handle multiple types of credit responsibly. The credit mix accounts for 10% of your credit score. Age of credit history. This is the count of how long each credit account has been open. This factor accounts for 15% of your credit score. You should try not to close old accounts, even if you're not using them anymore, or else it might hurt your age of credit history. Recent activity. This factor looks at current activities on your credit accounts. This factor counts for 10% of your credit score. Just remember that a lot of credit inquiries in a short period of time can hurt your score, so you should always avoid applying for too many new accounts at once. So what can you do to buy a house with an average credit score? The first would be conventional loans. Conventional mortgages generally have stricter requirements in terms of credit score as well as other factors like debt-to-income ratio and employment history. This is unlike government-backed loans, so you will most likely need a higher credit score than the minimum. Conventional loans are backed by separate private mortgage lenders instead of the federal government, so the eligibility requirements sometimes vary from lender to lender. The loans backed by Fannie Mae as well as Freddie Mac require a minimum credit score of 620, even though individual mortgage lenders are free to require a higher score at their discretion. If you live in the US, you can also consider USDA loans. USDA loans are offered to low and moderate income borrowers who are buying houses in rural and suburban areas. For these loans, you do not require a specific credit score. However, applicants need to demonstrate a willingness as well as the ability to handle and manage debt. Having a good credit score is one key factor for that. For USDA loans, you will most likely want a credit score of 640 or higher. Another popular one is FHA loans. For the FHA loans, the minimum credit score is 500. However, this credit score comes at a catch. You will have to put around 10% down, as opposed to the 3.5% down payment of a typical FHA loan. And to have the option for maximum financing, which is about 3.5% down payment, you will need a credit score above 580. For anyone who has served in the military, your best bet would be VA loans. These are only available to qualified veterans, service members, as well as certain surviving spouses of veterans. You don't really need to have a minimum credit score requirement. Instead, the VA requires lenders to review the entire loan profile, so make sure to do some research before applying. So what's the best way to improve your credit after getting a house? Whether you have a credit score of almost 850 or 550, there are several steps you can take to prepare yourself to meet with a mortgage lender as you begin your search for a new home. Improving your credit is not a one-and-done project, however. Instead, something you can and you should be doing at all times to be better prepared for big purchases. Here are 4 ways to improve your credit score. Number 1, pay down long-term debt. If you are able to pay down any long-standing debts, such as student loans or car loans, do this long before you meet with your mortgage lender. It's a great idea to do this because for one thing, it is one less thing to worry about. For another, by closing out debt, you are making it clear to your lender you have no problems with making monthly payments. And by paying down a car loan on time, you are showing the bank you are a responsible borrower. Number 2, keep everything organized. This factor matters more than you might think. After all, think about it. Lending agents are only human. Just imagine, you show up at a mortgage meeting with slips of messy financial papers sticking out of envelopes and overflowing from your briefcase. This might question your ability to pay back a loan in a timely manner. Mortgage lenders have a lot of paperwork to get through, and giving them a list of your income, expenses, and more will help expedite their approval process. You can consider your documentation as a roadmap of your finances. Number 3, pay more than monthly minimums. If you have maxed out your credit card in the past, then now is the time to take control of the situation. Also, you can make more than the minimum payment due each month. Even if it is only a few more than the minimum payment, it will show that the credit card reporting agencies are making a greater effort to pay down your significant debt and will improve your score. Number 4, don't close out paid off credit cards. Another tip to help convincing lenders you are a reasonable risk is keeping credit accounts open after you have paid them off. Even if you don't plan to use them anymore, a long-standing loan or line of credit shows a positive consumer-lender relationship, and it improves your credit score. And even if you pay off your credit card or line of credit, then just don't close it. The longer it is listed on your credit report, the more it will help your credit score. You can take baby steps to improve your credit score. Improving your credit score will eventually help you thrive financially when you find the house of your dreams. And if you are credit ready, don't let the news of higher credit standards scare you from buying now. And no one knows if or when lending standards will change again, so these standards may be the new normal. Don't forget to give this video a thumbs up and subscribe to the channel if you enjoyed it. Now, if you are serious about becoming a homeowner, I've put together an entire playlist full of different ways you can begin taking the necessary steps to buying your next home. So definitely watch these videos as well, and I'll see you in the next video.